If you walk through any major city in the world, New York, London, Dubai, Singapore, you'll see something strange that most people never consciously notice. Two people can stand on the same street corner, breathe the same air, live under the same economic system, face the same inflation, the same taxes, the same headlines, and yet one of them will quietly build extraordinary wealth over time, while the other remains financially fragile for decades. Why? Is it intelligence? Is it luck? Is it connections? Or is it something far less obvious and far more uncomfortable? Most people assume wealth is created by dramatic moments, a big idea, a breakthrough investment, a genius-level insight. But if that were true, wouldn't the smartest people in every room always be the richest? Wouldn't every Ivy League professor be wealthier than every entrepreneur? Wouldn't every economist be financially independent? But that's not what happens. In fact, history shows something almost counterintuitive. Wealth often accumulates not in the hands of the flashiest or loudest minds, but in the hands of those who quietly understand a few timeless principles and stick to them longer than everyone else. Let me tell you a story. Warren Buffett bought his first stock at 11 years old. 11! Most kids that age are worried about cartoons and baseball cards. Buffett was reading financial statements. When he bought that stock, Citi's Service Preferred, it dropped shortly after he purchased it. He felt the emotional sting of watching his money shrink. Eventually, it recovered. He sold it for a small profit. Soon after he sold, the stock multiplied in value many times over. That early experience shaped him, not because he made money, but because he learned a painful lesson about patience. He later said that moment taught him the cost of emotional decisions. Now pause for a moment. How many adults today make the exact same mistake an 11-year-old once made? Selling too soon, panicking too quickly, wanting results now. Was Buffett richer than his classmates because he was born smarter? Or because he learned early that money rewards time more than brilliance? Here's something most people don't realize. The overwhelming majority of Buffett's net worth came after his 50th birthday. In fact, the vast majority came after his 60s, not because he suddenly became smarter at 60, but because compounding needs time to reveal its magic. That's the invisible gap. Most people underestimate time. The wealthy build their entire strategy around it. Think about that carefully. If two people invest the same amount of money, but one stops after 10 years and the other continues for 40, the results are not slightly different. They are exponentially different, almost violently different. Yet we live in a culture that worships speed, quick returns, fast growth, overnight success. Have you ever noticed how uncomfortable people become when progress feels slow? Have you ever abandoned something not because it wasn't working, but because it wasn't working fast enough? That discomfort is expensive. Let me tell you another story. In the 1970s, a man named Ronald Read worked as a janitor and gas station attendant in Vermont. No Ivy League degree, no hedge fund, no tech startup. He lived modestly, drove used cars, bought a small house, clipped coupons. When he died in 2014, he left behind over $8 million, most of it to charity. $8 million? How? No inheritance, no lottery, no viral business? He bought blue-chip stocks, he reinvested dividends, and he waited for decades. Can you imagine the discipline required to ignore market noise for 40 years? To live below your means while quietly letting investments grow? The invisible gap isn't knowledge, it's behavior. Meanwhile, during those same decades, countless high-income professionals, doctors, lawyers, executives, earned far more than Ronald Read ever did, yet retired with less. Why? Because income and wealth are not the same thing. Income is what you earn, wealth is what you keep, and keeping requires restraint. Have you ever received a raise and immediately upgraded your lifestyle? Bigger apartment, new car, better vacations? It feels natural. You worked for it. But here's the hidden trap. Every lifestyle upgrade increases the amount of income required to feel stable. The wealthy often resist that urge. Charlie Munger once said the first rule of compounding is to never interrupt it unnecessarily. That doesn't just apply to investments, it applies to habits. Consider Jeff Bezos in the early days of Amazon. In 1997, when Amazon went public,
Analysts criticized him relentlessly. The company wasn't profitable, traditional metrics didn't make sense, pundits questioned his strategy. He could have optimized for short-term earnings. He could have made Wall Street comfortable. Instead, he reinvested everything back into growth. For years, at one point, Amazon stock fell more than 90% after the dot-com crash. 90%! Imagine holding through that. Imagine the doubt, the criticism, the fear. How many people would have sold? Bezos didn't just believe in his company, he believed in the long game. The invisible gap is not optimism, it's endurance. It's the ability to survive boredom. It's the ability to tolerate being misunderstood. It's the ability to delay validation. Now, let's make this uncomfortable. If you look at your own financial life, where do you see impatience? Where do you see emotional decisions disguised as logic? Do you check your investments too often? Do you compare yourself constantly to others? Do you feel behind because someone on social media appears ahead? Comparison is gasoline on financial insecurity, and insecurity leads to bad decisions. In 1999, during the dot-com bubble, technology stocks were skyrocketing. Taxi drivers were giving stock tips, college students were day trading between classes, traditional valuation metrics were dismissed as outdated. Warren Buffett refused to join. He was mocked publicly for not understanding the internet. Then the bubble burst. The Nasdaq fell nearly 80%. The people who had felt brilliant suddenly felt devastated. The difference wasn't intelligence, it was temperament. Morgan Housel once wrote that financial success is less about what you know and more about how you behave when you don't know. That's the invisible gap. When markets fall, do you panic or prepare? When markets rise irrationally, do you chase or step back? The wealthy are not immune to fear. They simply structure their lives to reduce the consequences of it. They keep cash reserves. They avoid catastrophic debt. They diversify intelligently. They prioritize survival over excitement, because survival gives you another chance, and another chance is priceless. Now let me ask you something deeper. What is your definition of rich? Is it visible consumption, luxury cars, designer clothes, social media proof? Or is it optionality, the ability to say no, the ability to walk away, the ability to sleep without financial anxiety? Many millionaires don't look wealthy. Thomas Stanley's research in The Millionaire Next Door revealed that most American millionaires live in middle-class neighborhoods, drive modest cars, and avoid flashy displays. Why? Because wealth that is visible is often wealth that is spent. Real wealth is quiet. It doesn't denounce itself. It doesn't need applause. There is a psychological comfort in appearing successful, but there is a deeper comfort in being secure. Which one are you chasing? The invisible gap between the wealthy and everyone else is rarely about opportunity. We live in an era where information is abundant, investment platforms are accessible, education is widely available. The gap is emotional. Can you stay consistent when it's boring? Can you stay rational when it's scary? Can you stay patient when others appear to be sprinting ahead? Compounding is not dramatic in the beginning. It feels insignificant. The first years are almost discouraging. Growth looks flat. Effort feels disproportionate to reward. But then something shifts. The curve bends upward. Momentum builds. And what once looked slow begins to look unstoppable. Most people quit before the bend. The wealthy stay for it. And here's the irony. From the outside, it often looks like luck. He invested early. She got in at the right time. They were fortunate. But luck favors duration. The longer you stay disciplined, the more surface area you give luck to find you. So perhaps the real question isn't how to get rich. Perhaps the real question is, can you become the type of person who deserves compounding? Can you build habits that protect future you from present emotions? Can you delay gratification in a culture addicted to immediacy? The invisible gap isn't taught in schools. It's not found in financial formulas. It's found in restraint. It's found in humility. It's found in patience measured in decades, not months. Two people can start with the same salary. Two people can live in the same city. Two people can invest in the same index fund. But if one of them panics during downturns, upgrades lifestyle aggressively, chases trends, and interrupts compounding repeatedly, while the other remains steady, conservative, and long-term oriented, the outcomes will not just differ, they will diverge dramatically. not because one was smarter, but because one understood something invisible, and once you see it, you can't unsee it. The wealthy don't win because they know more secrets. They win because they play a different psychological game. So now the question turns to you. Are you playing a short game in a long game world, or are you willing to endure the quiet years for the exponential ones? Because the gap isn't closed by intelligence, it's closed by behavior repeated long enough to matter. And that, more than anything, is the principle that separates those who appear wealthy from those who quietly become it.
There is a quiet tragedy happening in modern society. It's not a lack of intelligence. It's not a lack of opportunity. It's not even a lack of information. It's a lack of patience. We live in the most accelerated economic environment in human history. Information moves instantly. Markets move in milliseconds. Success stories go viral overnight. A teenager launches an app and becomes a millionaire before graduation. A cryptocurrency multiplies tenfold in a month. A video explodes and transforms someone into an influencer in weeks. And slowly, without realizing it, our expectations about time become distorted. We begin to believe that success should be fast, that progress should be visible, that effort should produce immediate results. But what if the real game of wealth is invisible for years? What if the people who win financially are not the ones who move fastest, but the ones who last longest? Let me take you back to 1994. Jeff Bezos was working at a hedge fund in New York. He had a stable, high-paying job. He was on track for a comfortable career in finance. Then he read a statistic that changed everything. Internet usage was growing at 2,300% per year. 2,300%! Most people would have read that and thought, interesting, then gone back to work. Bezos didn't. He drove across the country with his wife to start an online bookstore in his garage. Not an online empire, not a trillion-dollar company, a bookstore. In the first year, Amazon lost money. In the second year, it lost more money. In the third year, it was still losing money. Investors were skeptical, analysts were confused, competitors laughed. Why would anyone buy books online? And here's the question. If you were holding Amazon stock in 1999, when it dropped more than 90% after the dot-com crash, would you have stayed? 90%. Imagine watching $100,000 turn into $10,000. Would you call that patience or stupidity? For most people, it would feel like proof of failure, a sign to exit, a confirmation that the dream was over. But Bezos wasn't building quarterly profits. He was building infrastructure, warehouses, logistics systems, customer loyalty, a brand built on long-term trust. He understood something most people struggle with. Short-term pain does not invalidate long-term vision. And this is where the long game becomes uncomfortable, because the long game requires you to look foolish temporarily. It requires you to endure doubt. It requires you to sit through years where progress is happening beneath the surface, but not yet visible. How many people quit right before the breakthrough? Consider another example. In the early 1960s, a young investor named Warren Buffett bought shares in a struggling textile company called Berkshire Hathaway. It was not a glamorous investment. In fact, the textile business itself was dying. But Buffett wasn't buying textiles. He was buying a corporate shell he could use to acquire other businesses over time. Over time. That phrase sounds harmless, but it hides decades of discipline. Buffett didn't build Berkshire Hathaway into a conglomerate overnight. He spent years acquiring small businesses, insurance companies, candy makers, newspapers. He reinvested profits again and again. And here's what most people miss. The vast majority of Buffett's wealth was created after his 50th birthday. Let that sink in. Not at 30, not at 40, after 50. If you remove the compounding of the later decades, Buffett would still be wealthy, but not legendary.
The long game rewards duration, but duration is emotionally exhausting because the first years of compounding are boring. Have you ever started saving consistently only to look at your account after a year and think, that's it? The early stage of compounding feels almost insulting. The effort feels large, the growth feels small. This is where most people stop. They switch strategies, they chase higher returns, they look for shortcuts. But compounding punishes interruption. Charlie Munger once said that the first rule of compounding is to never interrupt it unnecessarily. And yet, interruption is almost instinctive. Markets rise, we chase. Markets fall, we panic. Friends brag, we compare. Headlines scream, we react. Each reaction resets the clock. The long game demands something rare, emotional stability. Let's look at someone who lost it. In the late 1990s, during the dot-com bubble, countless investors poured money into tech startups with no profits. The logic was simple. The internet changes everything. And in many ways it did. But valuation stopped mattering. Fundamentals were ignored. Risk was dismissed. People weren't investing in businesses. They were investing in momentum. When the bubble burst in 2000, the Nasdaq fell nearly 80%. Trillions of dollars evaporated. Now here's the uncomfortable truth. Some of those companies eventually became giants. Amazon survived. Apple recovered. Microsoft thrived. But the majority disappeared. The people who won were not the ones who chased the hottest trend. They were the ones who survived the collapse. The long game is less about picking winners and more about surviving losers. Have you noticed how rarely patience is celebrated publicly? We celebrate rapid growth, explosive returns, viral success, but no one goes viral online for steadily reinvesting dividends for 30 years. No one trends online for avoiding unnecessary debt. No one applauds the investor who quietly ignores speculation. And yet, those are the behaviors that build real wealth. Let me tell you about another man. Ronald Reed was a janitor and gas station attendant in Vermont. He lived modestly, he saved consistently. He invested in blue-chip stocks and reinvested dividends. For decades. No hedge fund, no insider knowledge, no advanced degree. When he died in 2014, he left behind over $8 million. Do you know what's extraordinary about that? He didn't accelerate, he didn't speculate. He didn't pivot every year. He stayed. And staying is harder than starting. Starting feels exciting. New plan, new energy, new possibility. Staying feels repetitive. The long game often looks like nothing is happening until everything happens. And here's the deeper psychological challenge. Modern society shortens our attention span. Notifications, news cycles, market volatility, constant comparison. It becomes almost physically uncomfortable to wait. But wealth does not reward urgency. It rewards consistency. Let's bring this closer to home. Imagine two people start investing at age 25. One invests steadily until 65. The other invests aggressively for 10 years, then stops, withdraws, restarts, changes strategies repeatedly. Even if their average returns are similar, the one who stayed consistent will likely end up dramatically ahead, because the long game compounds behavior, not just money. There's another layer here. The long game is not just financial, it's psychological identity. When you commit to decades instead of months, your decisions change. You avoid catastrophic risks, you prioritize durability, you think in terms of cycles instead of headlines. Amazon did not become Amazon because of a single brilliant quarter. Berkshire Hathaway did not become Berkshire Hathaway because of one perfect trade. Apple did not become Apple because of a single product launch. These companies survived downturns, criticism, failures. Steve Jobs was fired from his own company before returning to lead it to historic growth. If he had defined success by short-term validation, the story would have ended there. So let me ask you something uncomfortable. Do you want fast validation or lasting results? because those two often conflict. The long game requires you to sacrifice applause now for freedom later. It requires you to endure moments where others appear ahead of you. It requires you to ignore noise that feels urgent but is irrelevant long term. And perhaps most importantly, it requires humility. Humility to admit you cannot time every market. Humility to accept that growth will sometimes stall. Humility to stay disciplined when excitement fades. Most people don't fail financially because they lack opportunity. They fail because they abandon strategies prematurely. They confuse temporary stagnation with permanent failure. They interpret volatility as danger rather than normality. But cycles are normal. Markets rise, markets fall. Economies expand, economies contract. The long game assumes volatility. It doesn't react to it. There is a quiet strength in someone who can say, I will still be here in 20 years, not because they predict perfectly, but because they structure their life to survive unpredictability. And survival is underrated. In every financial collapse, there are two groups, those who were forced out and those who remained. Those who remained often emerge stronger, because the long game is not about constant acceleration, it is about endurance. So now ask yourself, are you
Good. Let's go deeper. Because the long game doesn't just test your patience, it tests your identity. Most people think wealth is about strategy, about picking the right asset, entering at the right time, exiting before the crash. But if that were true, the smartest analysts on television would all be billionaires. The reality is far less glamorous and far more uncomfortable. The long game is about who you become while you wait. Time amplifies behavior. If you are disciplined, time multiplies that discipline. If you are impulsive, time magnifies the damage. If you panic easily, decades will expose it. If you stay steady, decades will reward it. And here's what makes this difficult. The long game rarely provides immediate feedback. If you go to the gym for a week, you might feel sore. That's feedback. If you eat poorly, you might gain weight quickly. That's feedback. But if you invest consistently and intelligently, you may see very little visible progress for years. The progress is happening. It's just not dramatic yet. Compounding is deceptive in its early stages. It grows quietly, almost invisibly, and then suddenly it accelerates. But the acceleration only happens if the foundation remains intact. This is where most people sabotage themselves. They start well, they save, they invest, they stay focused, but then a market downturn hits, or a friend makes fast money in something speculative, or headlines create fear, and suddenly long-term plans are abandoned for short-term reactions. Let me tell you about someone who understood this differently. In the 1970s, an investor named John Bogle founded Vanguard. His philosophy was radical at the time. Instead of trying to beat the market, simply own it at the lowest possible cost and hold it for decades. He was mocked. Critics said investors would never settle for average returns. They wanted excitement. They wanted performance. They wanted outperformance. But Bogle understood human behavior better than most Wall Street firms. He knew that the average investor didn't underperform because of lack of intelligence. They underperformed because they couldn't stay still. They bought high, they sold low, they chased trends, they reacted emotionally. Index investing wasn't just a financial innovation, it was a behavioral solution. It removed the temptation to constantly interfere. And over time, trillions of dollars flowed into index funds, not because they were exciting, because they were durable. Durability is underrated. In nature, the species that survive are not always the strongest or fastest. They are the most adaptable and the most resilient. Financially, the same rule applies. The people who build wealth are not necessarily the ones who make the most in a single year.
They are the ones who avoid catastrophic mistakes across many years. Avoiding disaster is more powerful than chasing brilliance. Have you ever noticed how much of financial advice focuses on maximizing returns? Very little focuses on minimizing self-destruction. But look at history. The Great Depression wiped out fortunes. The 1970s inflation eroded purchasing power. The 2000 dot-com crash destroyed speculative wealth. The 2008 financial crisis devastated retirement accounts. The 2020 pandemic created massive volatility. And yet, in each cycle, the individuals who stayed rational, avoided leverage, and maintained liquidity not only survived, they often thrived afterward. Because when others are forced to sell, opportunity appears. But you can only take advantage of opportunity if you are still standing. This is the hidden advantage of the long game: optionality. If you remain stable during chaos, you gain choices. If you panic, you lose them. Let me ask you something directly. When markets fall sharply, do you think about opportunity or danger? Your answer reveals more about your long-term outcome than any stock pick ever will. Fear compresses time. It makes the present feel permanent. It makes temporary decline feel like irreversible collapse. But history shows something different. After every major downturn, markets eventually recover. Economies rebuild. Innovation continues. The timeline is unpredictable, but the pattern is consistent. And here's the uncomfortable part. The people who benefit from recovery are usually those who had the emotional strength to endure decline. That strength is built long before the crisis. It's built in small daily decisions, choosing not to overspend when income rises, choosing not to overleverage when credit is cheap, choosing not to speculate when everyone else is celebrating. The long game begins in ordinary moments. It is easy to say you are long-term focused when markets are rising. It is much harder when they are falling. Consider how many investors in 2008 swore they would never own stocks again, or how many people in 2020 predicted permanent economic collapse, or how many in the 1970s believed inflation would destroy the dollar entirely. Each crisis feels unique and permanent while you are inside it, but when viewed across decades, they become chapters. The long game requires perspective. Perspective reduces panic, and panic is expensive. There is another dimension to this. The long game is not only about investing, it is about career, skill development, relationships, and reputation. Jeff Bezos did not only build infrastructure, he built credibility with customers. Warren Buffett did not only compound capital, he compounded trust. Reputation compounds just like money. If you consistently deliver value, over time people trust you, opportunities increase, partnerships expand. But again, it takes time. Modern culture pushes urgency. Scale fast, grow aggressively, move quickly. Speed has its place, but speed without stability is fragile. Sustainable wealth is built like architecture, not like fireworks. Fireworks are impressive but temporary. Architecture is steady but enduring. Which are you building? Let's return to the psychological core. Why is patience so difficult? Because we are wired for survival in short-term environments. Historically, reacting quickly to threats was advantageous. Immediate reward was valuable. Long-term abstraction was less necessary. But modern financial systems reward long-term abstraction. They reward individuals who can ignore immediate noise. This creates tension between biology and economics. Your instincts tell you to act. Your strategy tells you to wait. And most people side with instinct. The long game requires you to override impulse. That is why emotional control is more valuable than financial intelligence. You can understand compound interest perfectly and still sabotage yourself by selling during fear. You can know diversification matters and still concentrate risk out of greed. Knowledge without discipline collapses under pressure. Discipline without brilliance often succeeds. This is why many wealthy individuals are not necessarily the most academically gifted. They are the most consistent. Consistency is powerful because it accumulates advantage invisibly. 1 year of disciplined investing doesn't change your life. 20 years might. And here is another paradox. The long game often feels slow until you look back. Ask someone who invested steadily for 30 years if it felt dramatic. Most will say no. It felt ordinary, routine, almost boring. But when they look at the result, it feels extraordinary. That gap between feeling and outcome is where most people lose faith. They want the feeling of progress now, but wealth often delays that feeling. Let me ask you something deeper. If markets were closed for the next 5 years, would your strategy still make sense? If no one posted their gains online, would you still be confident? If headlines disappeared, would you change anything? If your strategy depends on constant validation, it may not survive the long game. The long game is built on internal conviction, not external applause. And that conviction must be rooted in principles, not predictions. Predictions are fragile. Principles endure. Principles like diversification, principles like low costs, principles like liquidity, principles like patience. You may not predict the next crisis, but you can prepare for volatility. You may not foresee the next technological shift, but you can maintain adaptability. The long game is not about certainty, it is about resilience. Resilience means you don't need perfect foresight, you need structure, a structure that allows you to withstand shocks. And when shocks come, because they always do, your job is not to predict perfectly, it is to remain calm enough to act rationally. Most fortunes are not built during euphoria, they are built during recovery. Recovery rewards those who stayed, and staying requires something simple but rare, the willingness.
If you are still here, still reading, still thinking, that already says something about you. Because most people don't stay long enough to wrestle with uncomfortable truths. They want tactics, they want shortcuts, they want guarantees. But the long game does not offer guarantees. It offers probabilities, and probabilities reward those who endure. Let's go even deeper. The long game forces you to confront something most people avoid: uncertainty. We crave certainty. We want to know what will happen next year, next month, next quarter. We want reassurance that our plan is correct, that our sacrifices will be worth it, that our patience will pay off. But no serious investor in history ever had certainty. Warren Buffett did not know in 1973 that the market would eventually recover. He only knew that businesses with strong fundamentals were selling at prices that made sense over time. He acted on probability, not prediction. When Charlie Munger speaks about investing, he rarely talks about forecasts. He talks about temperament. He talks about sitting quietly while others lose their heads. He talks about avoiding stupidity more than seeking brilliance. Why? Because the long game is less about intelligence and more about emotional survival. You can be analytically gifted and still destroy yourself financially if you cannot tolerate volatility, and volatility is the price of long-term returns. No one receives high returns without experiencing periods of doubt. Let me ask you something uncomfortable. If your portfolio dropped 40% tomorrow, what would you do? Would you calmly review your allocation and assess whether fundamentals changed? Or would you feel a knot in your stomach, open your account repeatedly, and consider selling just to stop the pain? Be honest, because the long game doesn't test your spreadsheet, it tests your nervous system. In every cycle, the pattern repeats. In boom times, risk feels intelligent, leverage feels sophisticated, optimism feels rational. People stretch, they borrow more, they concentrate more,
They assume the trend will continue. In downturns, caution feels intelligent, selling feels safe, fear feels rational. People retreat, they liquidate, they assume collapse will continue. The irony? The crowd feels most confident near the top and most fearful near the bottom. The long game requires you to act opposite your emotional impulses, and that is profoundly difficult. There's a reason so many fortunes are built quietly and lost publicly. Quiet discipline compounds. Public panic destroys. Now let's step away from markets for a moment and examine something deeper. Identity. Do you see yourself as someone who thinks long-term, or do you see yourself as someone who reacts? Your self-image influences your behavior more than your strategy. If you define yourself as impatient, you will sabotage long-term plans. If you define yourself as steady and resilient, you will behave differently when stress appears. The long game begins in identity before it appears in your portfolio. Think about the wealthiest individuals you admire. Do they appear frantic? Do they constantly pivot based on daily news? Or do they operate with a calm that borders on indifference? Calmness is not ignorance, it is clarity. Clarity that short-term chaos does not invalidate long-term structure. But clarity requires perspective. Perspective requires history, and history is humbling. Look at the last 100 years. World wars, depressions, inflation spikes, currency crises, technological revolutions, pandemics, political upheavals. And yet, global productivity expanded, businesses innovated, markets eventually recovered and moved forward. The world has never been stable. It has only appeared stable between disruptions. If you expect stability, you will always be disappointed. If you expect cycles, you will be prepared. Preparation is not pessimism, it is realism, and realism allows patience. Now let's confront another difficult truth. The long game is lonely. When markets soar and you refuse to overextend, you may look foolish. When friends brag about fast gains and you stay diversified, you may feel left behind. When media celebrates speculation and you remain conservative, you may question yourself. This social pressure is powerful. Humans evolved in tribes. Belonging mattered. Conformity increased survival. Financially, conformity often increases risk. In 1999, refusing to buy tech stocks felt backward. In 2006, refusing to buy real estate felt overly cautious. In 2021, refusing to chase speculative assets felt outdated. And yet, those who maintained discipline avoided catastrophic losses. The long game sometimes requires temporary social discomfort. You must be willing to look wrong in the short term to be right in the long term. Are you comfortable with that? Because that question determines everything. Let's go even deeper. What is wealth, really? Is it a number and an account, or is it freedom? If wealth is freedom, then volatility is not just financial, it is emotional. When markets fall and you feel anxious, your freedom shrinks. When debt rises and you feel trapped, your freedom shrinks. When income depends entirely on fragile systems, your freedom shrinks. The long game is not about maximizing returns at any cost. It is about increasing durability and preserving autonomy. Autonomy to choose when to work. Autonomy to withstand downturns. Autonomy to say no. Durability creates autonomy, and durability comes from structure. Structure means not over-leveraging, maintaining liquidity, owning productive assets, avoiding concentration risk, controlling expenses, living below your means even when income rises. These are not exciting ideas, they are powerful ideas, because they reduce fragility. Fragility is the true enemy. In 2008, many people didn't lose everything because markets fell. They lost everything because they were fragile. Too much debt, too little liquidity, too much concentration. When stress arrived, they had no margin. Margin is invisible in good times. It is priceless in bad times. The long game is built on margin. Margin of safety, margin of liquidity, margin of patience. Now consider another dimension, time perception. Young investors often underestimate time. Older investors often overestimate certainty. If you are young, volatility is an opportunity. If you are near retirement, volatility is a threat. The long game changes shape depending on your stage of life, but the principle remains: survival first, growth second. You cannot compound if you are wiped out. You cannot recover easily from catastrophic loss late in life. This is why humility matters. Markets are larger than you. Economic systems are complex beyond prediction. Confidence without humility becomes recklessness. Humility without action becomes paralysis. The long game balances both. You acknowledge uncertainty, but you act within it. You accept cycles, but you build resilience. You understand that the future will surprise you, but you prepare anyway. Let's address something philosophical. Fear and greed are not flaws, they are signals. Fear warns of danger. Greed signals opportunity, but unchecked, they distort perception. A long game is about regulating these signals, not eliminating them. When everyone is euphoric, ask yourself, what risk am I ignoring? When everyone is panicking, ask yourself, what opportunity am I missing? Those questions require emotional distance. Emotional distance requires discipline. Discipline requires habit. Habit requires repetition. And repetition is built daily. Small decisions matter. Choosing not to increase lifestyle each time income rises. Choosing to invest consistently even when returns feel boring. Choosing to review allocation calmly instead of reacting impulsively. Choosing to read history instead of headlines. These small habits compound. And here is something few people admit. The long game can feel anticlimactic. There is no dramatic moment when you arrive, no fireworks announcing success. Often, one day you simply realize that you are stable, that volatility no longer terrifies you, that income flows without panic, that choices are available, that you are no longer fragile. And that realization feels quiet, but it is powerful, because quiet stability is rare. Most people oscillate between excitement and fear, between expansion and contraction, between optimism and despair. The long game smooths those extremes. It replaces drama with durability. Let me ask you one last series of questions. If markets fell 30% next year, would your life collapse? If inflation rose unexpectedly, would your purchasing power evaporate? If your income paused for 6 months, would you panic? If the answer is yes, the issue is not the market, it is structure. The long game is about strengthening structure before stress arrives, because stress always arrives. It may not.
And when you begin to understand that, something shifts inside you. You stop obsessing over what the market will do next week and start asking a far more powerful question. Who am I becoming through this process? Because wealth is not only an external outcome, it is an internal transformation. Every cycle tests a different part of your character. Booms test your humility. Busts test your courage. Sideways markets test your patience. Inflation tests your adaptability. Easy money tests your discipline. Scarcity tests your creativity. And most people fail not because they lack information, but because they lack inner stability. Look closely at financial history, and you'll notice a strange pattern. The same mistakes repeat across generations. Different technology, different currencies, different headlines, but the same human reactions. In the 1920s, investors borrowed heavily to buy stocks on margin because this time was different. In the late 1990s, people quit stable careers to day trade internet stocks because this time was different. In the housing bubble,
Families bought homes they could not afford because real estate never goes down. And every time, the story sounded reasonable in the moment. That's what makes cycles dangerous. They feel logical while you're inside them. Have you ever noticed how easy it is to identify bubbles in hindsight? It's almost embarrassing how obvious they look after they burst. The charts look absurd, the leverage looks reckless, the optimism looks naive. But while you're living through it, the narrative feels convincing. That's why the long game requires detachment. Detachment from narratives, detachment from crowd psychology, detachment from urgency. Urgency is the enemy of sound decisions. When you feel like you must act immediately, pause. When you feel like you are missing out, pause. When you feel like you must sell to survive, pause. The pause is powerful because most destructive financial decisions are emotional reactions compressed into short moments of fear or greed. If you stretch those moments, if you slow them down, you give rational thought a chance to re-enter the room. Think about the most expensive financial mistakes people make. They are rarely calculated errors. They are impulsive ones. Selling at the bottom because the pain feels unbearable. Over-leveraging because the upside feels irresistible. Concentrating too much because recent gains feel proof of genius. These are not analytical failures. They are emotional accelerations. The long game is emotional deceleration. It's choosing to slow down when the world speeds up. But slowing down requires confidence, and confidence requires understanding. Understanding how the economic machine works. Understanding that debt expands and contracts. Understanding that inflation erodes and resets. Understanding that policymakers respond to stress with interventions that often create new imbalances later. Once you understand that instability is structural, not accidental, you stop being shocked by it. Shock causes panic. Familiarity creates composure. If you know storms are part of the climate, you build stronger shelters. You don't curse the rain, you prepare for it. Now let's confront something even deeper. Your relationship with uncertainty is shaped long before you ever invest a dollar. If you grew up in scarcity, you may hoard excessively, avoiding risk even when it is rational. If you grew up in abundance, you may underestimate risk, assuming recovery is inevitable. Your financial behavior is often an echo of your past. The long game requires awareness of those patterns. Ask yourself honestly, when I make financial decisions, am I reacting to current reality or to old fear? Are you chasing security because you once lacked it? Are you chasing status because you once felt invisible? Are you avoiding risk because you once experienced loss? Money magnifies identity. If you are anxious without money, you may remain anxious with it. If you are insecure without wealth, you may remain insecure with more of it. That is why the long game cannot be separated from self-awareness. You can build a strong portfolio and still sabotage it if your inner world is unstable. There's a reason some lottery winners go bankrupt within years. The sudden wealth did not change their psychology, it amplified it. And there's a reason some quiet investors with modest incomes build durable wealth over decades. Their behavior is steady, their expectations are realistic, their impulses are moderated. The long game is less about maximizing opportunity and more about minimizing self-sabotage. That might not sound glamorous, but avoiding catastrophic mistakes is more powerful than chasing extraordinary gains. Warren Buffett once said, "The first rule of investing is not to lose money. The second rule is not to forget the first rule." That statement sounds simplistic until you understand its depth. If you lose 50%, you must gain 100% to recover. Recovery is harder than growth. That's why preservation matters. Preservation gives compounding time to work, and time is the most underappreciated asset in finance. Time smooths volatility. Time absorbs mistakes. Time allows recovery. Time rewards consistency. But time only works if you stay in the game, and staying in the game requires resilience. Resilience is built long before crisis. It is built when you maintain liquidity during prosperity. It is built when you resist lifestyle inflation. It is built when you diversify instead of concentrating. It is built when you refuse to overextend. Then, when stress arrives, you are not scrambling, you are adjusting. Adjustment is very different from panic. Adjustment is strategic. Panic is reactive. The long game transforms you from reactive to strategic, and strategy requires long horizons. Ask yourself, are you measuring progress quarterly, yearly, or over decades? If you measure quarterly, volatility feels like failure. If you measure over decades, volatility feels like noise. Perspective changes emotion. Emotion influences action. Action determines outcome. Now imagine two individuals starting with identical portfolios. One checks daily, reacts frequently, trades impulsively, adjusts allocation based on news. The other checks periodically, rebalances calmly, ignores noise, and sticks to long-term allocation. 10 years later, who is more likely to have superior results? It's rarely the one with more information. It's usually the one with more restraint. Restraint is a competitive advantage. In an age of constant data, restraint is rare. You can access markets instantly. You can trade instantly. You can react instantly. But just because you can act does not mean you should. In fact, accessibility often increases fragility. The long game sometimes means doing less. Less trading, less reacting, less predicting, less noise. More thinking, more planning, more observing, more waiting. Waiting is uncomfortable because it feels inactive, but waiting is often strategic. Think about farmers. They plant, they water, they tend, but they cannot force growth. They respect seasons. Financial seasons exist too. There are seasons of expansion, seasons of contraction, seasons of rebuilding. If you try to harvest during winter, you fail. If you abandon the field during winter, you also fail. The long game respects seasons. It does not expect perpetual summer. Now let's tie this back to human nature. Fear narrows vision. Greed narrows vision. Both extremes reduce clarity. The long game widens perspective. When you widen perspective, temporary losses shrink in emotional intensity. You begin to see volatility as tuition. Yes, tuition, because every cycle teaches. It teaches about leverage. It teaches about liquidity. It teaches about concentration. It teaches about resilience. If you reflect after downturns instead of blaming circumstances, you evolve. Evolution is compounding applied to character, and character applied to capital produces durability. Ultimately, wealth is not just numbers rising, it is optionality increasing. Optionality to change careers, optionality to relocate, optionality to support others, optionality to withstand crises without desperation.
And when you begin asking that question, how long can I remain disciplined? You step into a completely different relationship with money. Discipline over long stretches of time is not loud. It does not demand attention. It does not produce dramatic stories for social media. It rarely goes viral. But it builds something far more valuable than attention. It builds trust. Trust in your own decision-making. And self-trust changes everything. When you trust yourself, you no longer chase every new idea that promises quick gains. You no longer panic when volatility appears. You no longer need constant reassurance from experts, influencers, or headlines. You understand your structure. You understand your exposure. You understand your timeline. Confidence built on hype is fragile. Confidence built on experience is durable. And experience in financial markets is rarely comfortable. There will be moments when everything feels uncertain, when respected analysts disagree violently, when political shifts create anxiety, when interest rates move unpredictably, when currencies fluctuate, when businesses fail that once seemed invincible. These moments are not anomalies, they are features of the system. The economy is not a straight line upward. It is a rhythm, expansion and contraction, innovation and correction, excess and reset. If you expect smoothness, you will be shaken. If you expect rhythm, you will adapt. Adaptation is one of the most underrated financial skills. Adaptation does not mean constantly changing direction. It means adjusting intelligently without abandoning your foundation. It means recognizing when the environment has shifted and responding with calm precision rather than emotional force. Consider how many investors mistake movement for progress. They rebalance aggressively, shift strategies, jump between asset classes, and constantly seek a new edge. But movement without clarity is just activity. Activity is not the same as advancement. The long game requires clarity about what you are actually building. Are you building status or security? Are you building excitement or endurance? Are you building speed or sustainability? These questions are not abstract. They shape how you allocate capital, how you manage risk, and how you define success. For many people, success is measured by comparison. They measure themselves against friends, colleagues, or online personalities. But comparison is dangerous because you never see the full picture of someone else's balance sheet. You see outcomes, not leverage, gains, not risk exposure, lifestyle, not liabilities. The long game shifts your comparison from others to your former self. Are you more resilient than you were 5 years ago? Are you less reactive than you were during your first downturn? Are you more diversified than you were when you first started investing? Growth in wealth often mirrors growth in maturity, and maturity comes from perspective. Perspective often comes from pain. Almost every seasoned investor can recall a mistake that changed them, a trade that went wrong, a position that was too concentrated, a moment of panic that locked in losses, a missed opportunity caused by hesitation. These experiences hurt, but if reflected upon, they become turning points. Pain without reflection leads to bitterness. Pain with reflection leads to wisdom. Wisdom is not the absence of mistakes, it is the reduction of repeated mistakes. And reducing repeated mistakes is one of the most powerful accelerants in wealth building. Let's talk about time again, but in a deeper sense. Time does not just compound capital, it compounds behavior. If you behave recklessly for decades, recklessness compounds. If you behave prudently for decades, prudence compounds. Over long horizons, character becomes destiny. That may sound philosophical, but in finance, it is literal. If you repeatedly prioritize liquidity, you build flexibility. If you repeatedly prioritize debt-fueled growth, you build fragility. If you repeatedly reinvest rather than consume, you build capacity. If you repeatedly expand lifestyle to match income, you build dependence. Small patterns repeated over long periods become structural realities, and structures determine survival. Survival is rarely celebrated in bull markets, but it is revered in bear markets. When downturns arrive, the survivors become leaders. They acquire distressed assets. They negotiate from strength. They move while others retreat. The ability to act during crisis depends entirely on how you behaved during prosperity. Did you conserve capital? Did you avoid excessive leverage? Did you build cash reserves? Did you maintain diversification? If so, downturns become opportunity. If not, downturns become destruction. The long game is about positioning yourself so that volatility becomes asymmetrical in your favor. Losses are manageable, opportunities are accessible. But that asymmetry requires restraint during good times. Restraint is emotionally difficult when optimism is contagious. Human beings are social creatures. We absorb sentiment from those around us. When everyone seems confident, it feels safe to be confident. When everyone seems fearful, it feels safe to be fearful. But markets reward independent thinking tempered by humility. Independence without humility becomes arrogance. Humility without independence becomes paralysis. The balance between the two is subtle. You must believe in your long-term structure, yet remain open to learning. You must maintain conviction without becoming rigid. You must evolve without abandoning discipline. This balance is not static, it is dynamic. It requires awareness. Awareness of macroeconomic trends, awareness of personal bias, awareness of emotional triggers, awareness of risk exposure. The more aware you become, the less reactive you are. Reaction is instinctive, response is intentional. The long game replaces reaction with response, and response creates consistency. Consistency creates compounding. Compounding creates freedom. Freedom creates perspective, and perspective reduces fear. Notice the cycle. It is not just financial, it is psychological. At the deepest level, wealth building is a psychological discipline expressed through financial decisions. This is why two individuals with identical information can produce radically different outcomes. Information is abundant, discipline is scarce. Scarcity creates value, and disciplined temperament in volatile environments is extremely valuable. When you cultivate that temperament, you stop being shaken by every shift. You begin to observe cycles with curiosity rather than anxiety. You understand that recessions cleanse excess, that inflation redistributes purchasing power, that policy changes alter incentives, that innovation disrupts old models. You stop personalizing volatility. You realize downturns are not attacks on you, they are systemic adjustments. This shift from personalization to contextualization is powerful. When losses feel personal, they feel humiliating. When losses are contextualized, they feel manageable. Context reduces shame. Shame clouds judgment. Clear judgment is essential in high-stress financial environments. Now consider another dimension, legacy. If your wealth is only about your own comfort, your horizon may be shorter. If your wealth is about generational stability, your horizon expands. Long horizons naturally reduce impulsiveness. When you think in decades rather than months, patience becomes rational. Patience is not passive. It is strategic waiting aligned with a broader vision. Vision protects you from distraction. Without vision, you drift. With vision, you filter. Filtering is powerful. You ignore noise that does not align with your direction. You decline opportunities that do not fit your structure. You avoid leverage that threatens durability. Clarity of direction reduces temptation. Temptation is constant in financial markets. There will always be a new asset, a new strategy, a new narrative promising outsized gains. But the long game is rarely about novelty. It is about repetition. Repetition of disciplined allocation, repetition of rational assessment,
repetition of prudent risk management. Repetition is boring, but boring compounds, and compounding is extraordinary. Over long enough time horizons, steady behavior often outperforms sporadic brilliance. Brilliance can create spikes, discipline creates trajectories, and trajectories shape destinies. As you continue this journey, remember that your greatest